Okay. Now also moving along a little bit, this SIAS session has been conducted for all members of the public, but from the month of April onwards, we are gonna have this as an exclusive event for SIAS members. All right. So just to keep you informed that as I say, American Express membership has its privileges. All right.
Yeah. So I think Ben, I think long time followers of SIAS and yourself knows that you have some investments into Amazon. So yesterday's news of Jeff Bezos. Any thoughts?
Yeah, so the guy is going to be an executive chair while the guy running AWS is going to take over as the CEO. I think that's good for him because obviously he's got, hobbies. He's got his, uh,
Wall
you
Street
know,
Journal, is that right? Yeah.
Wall Street Journal. No, not Wall Street Journal. It's Washington
Oh,
Post.
Washington Post. Yeah.
Yeah, Washington Post. Wall Street Journal is kind of pro-conservative, pro-right, if you can imagine. While the New York Times as well as Washington Post are more like pro-left, more pro-democrat. So anyway, the guy is very busy. He's got his spaceship outfit that he needs to kind of get a hold of because it seems to be lagging behind SpaceX, obviously.
Mm-hmm.
Then, of course, he's got his new wife, not so new anymore, but he's got other things to do. Huh?
Yeah.
Anyway, his business is doing well, and most of the profits is actually driven by the AWS, Amazon Web Services division. Anyway, so it's kind of nice that that guy is taking over. And apparently, this guy is has been at Amazon since 1997, so he's not a newcomer.
Yep.
All
So
right.
it's really like moving from day one to day two for Amazon.
Well, that's like 23 years to move from day
Yep.
one to day two. But anyway, I guess it's good because over time we might actually be comfortable with Amazon is actually AWS with a retail
Mm-hmm.
front. Is no longer an online platform. The online platform is kind of the by the way thing, because it has always been that the margins have been very thin. But of course, using the AWS, it drives a lot of traffic to the online shopping platform as well as it supports quite a. I mean, other people can use AWS for their own retail front ends as well as analytics purposes. So I think that's good. All right, because data is the new goal apparently. All right, so you just ask Alibaba or Tencent. So that's
Alibaba also has its own cloud or something, right?
yeah, everybody wants to have cloud because once you control data, basically you can mine it for insights and all that, right? So if you know what people are buying, obviously you can recommend things that they are more likely to buy, so on and so forth. Right? You can also sell that kind of data to other advertisers. Just same as Facebook. They
Yep.
track what people view and all that, as well as YouTube. What you watch. That's why once you watch the first 3 or 4 cat videos on YouTube, they will start recommending cat videos all the way. And you see cats doing funny things like falling into the toilet bowl or jumping on dogs or waking their owners up by farting in their face. Kid you not, I saw it once. Yeah. So that's how it works. So data is the new goal. So as long as you have got a critical mass of online activity and you can track that, you can mine that, and you can even sell it. So that's how it is. So that's why there's a race to get as many eyeballs on your platform as possible. And in that regard, China is obviously moving forward because they have got what 1.4 billion people or so, a few hundred million online. And of course, the entire population of the US is, between 250 to 300 million, I think. So, it can't really compete. So that's why they've got, kind of a head start, which is all fine, right? It's business.
Yeah. The law of large numbers kicking in.
Yeah.
Yep. I think it seems like the maybe we just move on to the another topic that I think has fizzled over the last 3 days. So GameStop seems like the game has somewhat stopped.
Yeah.
Yeah.
So we're going to talk about that in a few minutes. But
Yeah, I
yep.
think the focus is more really I think Alibaba and Alphabet recently, it's more the market is more focused on the earnings, given that it's the earnings season now. So the GameStop frenzy more or less like fizzled out over the last 3 days. So I think it's back to a bit of normalcy, I guess.
Yeah, the GameStop thing is kind of like similar to a Ponzi scheme. Although, to be fair, it is not a Ponzi scheme because it was not. At least we don't know that there's any criminal intent, right?
Yeah.
But the thing is that it's structured in such a way that the people who go in first obviously will have made tons of money, right? So anyway, we'll save that for later on. Yes, the earnings season in the US is going very well, and we'll talk about that also. But as you can see, Google's result was basically whoa, fantastic. It was like wow, historical high numbers for their revenue and earnings. So Google is flying high. Amazon wasn't too bad as well. And of course, you've got Apple and Facebook that released results last week, which were good as well. But the market kind of dropped despite that because of the GameStop debacle, as well as their outlook or the forecast that both Apple and Facebook provided were not sufficiently comfortable for the analysts. So there was a bit of profit taking there, but I think that's normal functioning of the market, so nothing too crazy about that. All right, let me just check that my PowerPoint slides are all teed up. Yes. So, ladies and gentlemen, we're going to start in a few minutes, but we have got 2 minutes before we actually begin the main event. Today, we are going to be trying something else. If you do have a question, you can click the raise hand icon, the raise hand icon from your reactions bar at the bottom there. I'm not sure whether you have a raise hand icon. You need the latest version of Zoom. If you don't have, you can write your question in the chat. All right, chat screen. All right, so since we have another 2 more minutes, if you do have a question and you want to kind of get it in now, this will be a great time to do that because we've got quite a busy agenda this evening. We may not be able to get to all your questions at the end. We will try. Yeah. This Chinese New Year is going to be different.
Yeah. So what is that? What is the guidelines now? Two families of 8 per household. Is that right?
I think you can have a visiting party of 8 or something.
Yeah.
Not gonna work for my wife's side.
Because we have a very huge family.
Yeah, she has got an army of nieces and nephews. Normally they come in a together, so we call it the horde. Like the horde will come.
Yeah.
So the nephews and nieces all will come with, of course, the cousins and all that. So it's like we're gonna have 30 people, more than 30 people at one time, and now we're gonna have 8. I'm not sure how that logistics is gonna work. Maybe we'll just do a 40 people on Zoom kind of thing, and then I pay the
PayLah, yeah. And I think MAS and the banks are advocating for digital ang pao now.
Yeah, sure, they make some money out of that. Yeah. And okay, so strike while the iron is hot, I suppose. Okay, so let's okay, should I share my slide? I think it's 7 o'clock. I think I should just kick off. Okay, so again, the disclaimer is that as you have seen in the previous slides that were running around, whatever we discussed today cannot be misconstrued as a recommendation. Please see your licensed financial professional before making a trade in the market. So we had a couple of questions collected since the last round, as well as ones that came in over the week or so. So let me just quickly run through this. Hopefully, you've got enough time for the Q&A session at the end. The first question is, we had a previous submitted question for Nano Film Technologies International Limited. Okay, so what are the prospects of this company? This is a Singapore-based company. Yeah, for this year 2021, or rather fiscal year 2021. All right, so just kind of to let everybody know what they do. So this Nanofilm Technologies International, basically they are a company that specializes in advanced materials and nano products. So you think of film, all right? So film obviously can be used in many applications, but also in printed circuit boards, so on and so forth. And they have got quite a few, not really sure what's happening on my screen, but they've got quite a few customers. And this company has been around for quite a long time, but they only went public in October last year. That means October 2020. The IPO price at that point in time was offered at $2.59, and the kind of the price this afternoon, not the last done price, but somewhere around between 2 to 3 p.m. today, was about $5. So as you can see, is almost double in a span of maybe 3 months or so, right? Okay, so who are the owners of this company? So as you can see, there are quite a fair bunch. Only picked out some of the major owners. You have a few institutional clients like Venezio Investments, Venda One. I don't really know who they are, so they could be private holding companies or hedge funds. I don't know. Then you got capital group companies. And then you've got JP Morgan, Goldman Sachs. Not to say that JP Morgan and Goldman Sachs are investing in their own money. They're probably taking a stake in this company on behalf of their own clients, which we do not know who they are. So the biggest stake is from this holding company, a private company actually, called Pearl Yard Holdings. I don't have any information on that. Is because it's a private company. And of course, the executive chairman and founder, Dr. Shi, has got a 7.7% stake. So for all you guys out there, Dr. Shi used to be a faculty at NTU, and he, went out and started his own business. All right, and Temasek has got a sliver of a bit of a weight there with 0.86%. So as you can see, although this company has been around, or rather has been made public only for the last few months, not too shabby in terms of too shabby in terms of the number of big institutional shareholders. Could be better, but I guess it's all right. Okay, now who are the customers? To be totally honest, I'm not an engineer, so I only recognize one name there. That's Canon Incorporated. Now, obviously, they have got quite a lot of companies here as well. A lot of them are actually based in China, and these are the ones that these are not household names because they don't actually make consumer products. So they make probably intermediate goods that go into finished products, or they make things that go into your, I don't know, computers or whatever. So they don't actually have got consumer names as well. So again, not really an expert on this, but this is a list, a laundry list of the selected major customers. Now, we don't really have got a lot of information, or not that I could find on Bloomberg actually, but just a quick glance at the solvency and debt ratios. The current ratio is at a healthy 2.0, which is quite nice, and the quick ratio is at a 1.5, which is also quite good. Obviously, for these two kind of ratios, you want to have a number as high as possible above 1. Anything below 1 is probably a big red flag. But of course, anything which is like 5, 6, 10, or 20, that would be a bit obscene, as in, they've got too much liquid assets, and they're probably not deploying it for better use in the company. So hovering between 1.5 and 2, that's kind of nice, sweet spot. And if you look at the debt to assets ratio, it's only at 25%. So this company is not very leveraged, which of course bodes well for the ability to take on more debt, as well as to pay down any kind of existing debt that they have. Just for our friends out there, just a little bit of academia here. Debt is actually cheaper than using cash, because from a tax perspective, you can actually have a what you call a what do you call it now? Tax rebate for debt, right? So anything which is incurs debt or is an expense like restructuring charges and all that, you actually get a tax rebate. So in a sense, debt is actually cheaper than using cash. So some debt level is actually quite healthy for any kind of company. Okay. Now, this is basically the revenue, both actual as well as forecast. The actual numbers are in orange. I think this is orange. And the forecasted numbers are in white. So as you can see, for fiscal year 2017 and 2018 and so on. This is just prior to the IPO. The numbers were, of course, on an uptrend, and the forecast is again for very healthy growth going forward as well. All right. So again, it looks like quite a nice line. I think as the year progresses and we see more of the results coming on a quarterly basis, then we can of course ascertain whether or not the growth projected here is makes sense or not. All right. So just do remember this company is only public for the last 3 months. Okay. So sorry, Henry. I think you need to disable. Can we disable the writing or something, because we have a participant that's kind of writing. Do you guys see these blue lines? All right. So next we have got the earnings. The earnings forecasted all in white. So as you can see, we don't really have any numbers right now, simply because we need to have the quarterly numbers kind of show up as we progress through the year to be able to forecast that as well. All right, but as usual, if your revenue is forecasted to be going up, then your earnings should as well. Similarly, if they are able to maintain the margins. All right. Now, what is the consensus analyst rating? There are 4 local companies that actually cover this stock. So you have got UOB Kay Hian, CIMB, I think Macquarie, and Credit Suisse. Yeah. So the 4 banks are covering this. All of them have got a buy recommendation with a 12-month target price of $5.36. All right, Singapore dollars. All right, so the current price as of this afternoon was hovering about $5. So that represents about a 7% upside. Okay, now is really, you need to think about it. 7% for the next 12 months. Is that, kind of good enough? All right, for you. All right, we're going to talk a little bit about analyst ratings going forward. So let's move on. Now, the second question is, what is your view of investing in clean energy companies? I don't really have got any slides for this, so I'll just speak freely. The idea is that if you look at the new Joe Biden administration, so he has put climate change as well as clean energy front and center of his agenda. That is a huge change from the Trump administration. So obviously, it's not just all talk. They're going to be policies, and I think they're going to be dabbling a little bit in tweaking the tax code as well, basically to kind of encourage people, incentivize companies to use clean energy. So that worked out fairly well in places like Germany. So Germany for a time was kind of leading globally in terms of clean energy, solar panel installation, so on and so forth. Of course, it was also helped by the plummeting prices of solar panels because of China entering the market. But it was kind of the right time for them, and because of the government incentives as well as the very quickly falling prices of solar panels, they actually went into clean energy in a big way. All right. Germany is also, of course, very big in nuclear as well. Yeah. So there are, of course, pros and cons for nuclear power. But I guess what is not, what is undisputed is that if there are no accidents, nuclear power is fairly clean. All right. So I think the view that we have, and of course you have got, what was it? General Motors. General Motors has got a target of 2035 to have all their vehicles using electric rather than the combustion engine. So I think the kind of the center of gravity is edging towards clean energy. So companies generally in that space, and all the value chain of the clean energy, you could be in R&D for, let's say, battery, or it could be the production of high capacity batteries, or maybe the distribution grid, or what have you, solar panels. I think that is probably going to bode well for the next few years. So I think the momentum is behind that. And obviously, clean energy companies tend to, I would suspect, tend to rate quite highly in terms of ESG rating, right? And there are fund managers in the US, like BlackRock, and so forth, which are progressively trying to, pay more attention in terms of investing into companies which are ranked highly in terms of ESG as well as clean energy, right? So going forward, you can see a lot more emphasis placed on that. So if you look at company A and company B, both are very comparable, good prospects, similar prospects, so on and so forth. But company A is a clean energy company, while company B is not so. Then obviously, all things being equal, all these big fund managers will probably want to invest in company A. All right, so I think that is gonna be the theme for the next few years. Clean energy. That's all good. Anyway, you're saving the planet, right? Okay, next. Let me see my PowerPoint. Okay, next question 3. Question 3 and question 4 are kind of similar, but let's deal with them in turn. What are the merits and demerits of banks and companies executing the share buyback? All right, so for our friends out there, share buyback simply means that the company itself is taking out money from its bank account, that means the treasury of the company, and going into the open market to buy back its shares. All right, so that is what you call a share buyback. So what are the pros and cons? The pros is obviously once you buy the share, the amount of or the number of outstanding shares out there in the open market is less. So again, it's a supply and demand thing, right? So if demand is the same while supply is less, then obviously the price will go up. So companies, or historically, some companies have executed very well in terms of their share buyback. For example, many years ago, and I'm not sure whether it's happening now, my old employer, JP Morgan, actually executed a series of share buybacks. And of course, that obviously supported the share price. But at the same time, it also was a good signal for investors, because the only time you want to execute a share buyback is one, when you think that the current share price is too low, therefore you got to buy it, right? So it's cheap, it's too low, therefore the company is worth more. That's one. And the second thing is, well, they need to use cash to buy back the share. So the fact that they have the cash means that this is a relatively well running company, right? So they're profitable, and they probably are confident that they can remain profitable in the future. Therefore they're happy to use the cash now to buy back their own shares. So from a market sentiment perspective, a share buyback is generally seen as favorable, because the company is seen as profitable, and therefore it doesn't mind using the price, using its cash to buy back share. And also the company probably thinks that the shares are undervalued, and that's why they are happy to use cash to buy it back. So those are the advantages. The disadvantages, of course, you have to spend money to buy the shares, right? And you need to go into the open market. So once people figure out that you are going to be spending X billions of dollars buying back your share, then of course that might lead to some volatility in the market, some liquidity issues if you don't plan your share buyback properly, and you might be have to buy the shares back at a higher price than what you expected. So these are kind of the transactions or the operations side of things of actually doing a share buyback, which of course will be transparent to you and I, because we are not in the company itself. All right. So what are your views for the long-term small shareholder? Well, I'm going to assume that you're a Singapore resident and you are not an American citizen, or you're not residing in the US. The reason why I'm making this assumption is because we need to talk about taxes. All right. So if you are in Singapore and you invest in a company, you have to pay a withholding tax of 30%. And that is for the dividends. All right. If you go to any local broker or any broker, you sign the what is it called, the IR8 band, or W8 band, sorry, the W8 band form, attesting that you are not a US tax resident, then you don't have to pay capital gains tax. Right. So you see, if the company uses cash to pay out its dividend, even if you're in Singapore, you're going to be hit by the 30% withholding tax, because regardless, you have to pay tax on dividend, right? But if the company uses cash to buy back its own shares, and the share price goes up, and you sell the share, you make capital gains, well, it's not taxable for you, because you have signed the W8 band form, and you're not a US tax resident. And guess what? Obviously in Singapore, there are no capital gains tax as well. All right. So from a tax perspective, you would rather not receive dividend, you rather receive capital gains, again, assuming that you're a Singapore tax resident. Okay. But of course, all this is academic because you know, this will only be significant if you buy a lot of US shares, like we're talking about, you know, hundreds of thousands, millions of shares, right? So if you're just buying one share of Amazon and all that, I don't think that's really going to be significant. Yeah. Okay. Right. Next question. Oh, sorry. There's one more drawback of share buyback, because once the company does a share buyback and the share price goes up, if you want to kind of lock in your profit, you have to sell the shares. You can't own it anymore, right? That's to get the capital gains. All right. So that's kind of a disadvantage, because you're out of the game and you need to get in again at some other point in time. All right. So that would be the disadvantage of accepting capital gain versus accepting dividends. Okay, so question 4 again is related to question 3. So let me just skip to the choice part here. So why do the banks or the companies choose not to return the surplus cash to the shareholders by way of a special dividend? Well, because if you're talking about US companies, it's really because of the tax, right? Now, even in Singapore, although you don't pay dividends, the dividends are actually already taxed at the corporate level, because obviously when a company makes money, there's profit, company is subject to a corporate tax. Whatever there's remaining net of the tax will then be, of course, can be given out as dividend. So, so if the company makes, $100 in profit, there's going to be corporate tax. Whatever that's left can be given out as dividend. So as you can see, you are in a way already paying for the corporate tax, because whatever dividend you're going to be receiving is already net of tax. All right. So capital gains are not taxed in Singapore. Again, that's great, right? So, so from a tax perspective, it's always nice not to receive dividend, and to really just get it as a capital gain. All right. So that could be a reason, because obviously banks, are mindful of that, especially to institutional investors and big hedge funds, so on and so forth. You want to make sure that you want to give as much return back to the shareholders as possible. That could be one reason. All right. So would you agree it's more beneficial for long-term shareholders to get this payout? Again, I would say that I would prefer to, get my return in terms of capital gains rather than dividends. And really, personally, I'm not concerned about having to sell my share here and looking for something else to buy, because there's always an opportunity in the market. All right.
Ben, maybe I just add on to the point. So I think maybe this person raised this question because of what they see in Singapore, because I think MAS has recently or sometime last year put a 60% cap on the dividends. So I think the banks, as a result, because there is a limit to how much dividends they can pay, they choose to do share buyback instead of giving out the dividends as mandated by the MAS. So I mean that could be one way that they try to sort of reward the shareholders through the latter rather than dividend distribution.
That's a good point. And I suppose, share buybacks are not actually that common in Singapore, so it might actually raise a few eyebrows. But this is actually quite common overseas. All right. So I don't think it's anything to be concerned about. Question 5. So market volatility seems to be returning, fueled by the speculation of GameStop and the short squeeze counter. Do you think this can lead to a major correction? I think this question has been superseded. So as you can see in last night's trading session in the US, GameStop has fallen by 50%. So a lot of the stocks that were boosted by the Reddit army has already come down, and as Fang Wu and I were just chit-chatting just now, it's a little bit like a Ponzi scheme, although you can't call it a Ponzi scheme because there is no criminal intent behind there is at least not proven. So it's just a bunch of people who kind of like were a bit angry that the hedge fund managers were shorting their favorite stock, or they wanted to get back at all these fat cats. So they all decided to go and target a a very cheap company and buy it up. And of course, they did that. The price moved. Liquidity was very thin, so the price was moving very quickly. And it caught a lot of people by surprise. And of course, all the auntie and uncles and other retail people joined in and pushed the price way up. Now, the reason why I call it a little bit of a Ponzi scheme, but it's not obviously, is that the people who got in first are the ones that are now all the way laughing to the bank. Maybe they're buying themselves new BMWs and all that. And of course, the auntie and uncles who bought it at the last before the price trashed by 50% are the ones that are now having some kind of heartburn. I don't know. All right. So as you can see, in Singapore as well, there are a lot of internet chat forums and all that where people can go in and talk good things or talk crap about their favorite or unfavorite stock, and then they try to convince people and motivate them to take certain actions in the market. Well, just be aware that if you don't really know who the patsy is in the kind of chat sessions, it's probably going to be you. You don't want to be the last person that gets into the trade, because the person that got in first is probably selling to you, and they are not your friends. You have never met them. They're just some online personality. Everybody is in it for themselves. All right. So this band of brothers, this Reddit army, turned out obviously to be a band of mercenaries, because they didn't really care about each other. They were simply just betting together for a short-term speculative trade. And of course, the people who got in first are now the winners. All right. So, I guess some form of sanity has returned to the US stock market, and of course, the focus was back to earnings. There wasn't any dismal news about the COVID-19, at least not yesterday. All right, so yesterday's trading session was really all about the results of Alphabet, Google, which was very, very spectacular, and of course Amazon, so on and so forth. All right, so we'll talk a little bit about the US stock market in a while, but looks like at least for the time being, the Reddit army has been tamed, and these companies are now falling back to their fair value. All right. Oh yeah, here. Now we're talking about the US stocks. Yeah. So we had a different question previously about US companies. So this participant listed a bunch of companies. I can't cover them all, and really, because we SIAS, we don't really have a MES license, so I can't make specific recommendations. So what I can do is basically kind of curate the information already out there and to kind of let you guys know, and you can make your own opinions on that. All right. So very quickly, of course, Facebook is Facebook. If you don't know Facebook, then obviously you've been living under a rock for the last 20 years. Google is, of course, Google is better than Bing, is better than Yahoo search. And of course, they make almost all of their money based on advertising. So when you click on links from a Google result, basically they collect some money. So they are really good at that. Sorry. So Amazon has got a few specific business drivers. You have got the platform thing where you can go in to buy diapers and have it delivered to Singapore. So Amazon Prime and all that. You also have got the studio part of it, Amazon Prime, which is kind of like free if you got your Amazon Prime account. So you basically can watch videos. There are quite a lot of good selections, but in Singapore, not as good as Netflix. But they do have. Oh, today is Wednesday. They do have The Expanse, which is one of my favorite science fiction shows right now. But of course, for this season 5, I think they kind of cheapen out on the budget, so there's not a lot of CGI with spaceships and all that. But the books are really good. All right. And the other part is the last part, which is the one which is by far the most profitable, is Amazon Web Services, which they actually use to power their own online shopping platform. And of course, you can use, and anybody can use. You basically pay them some money to use some of these services from online AWS. So for example, you want to host your website, or you want to have a shopping cart, or you want to have analytics that Amazon uses internally, you just pay them some money, basically rent the services. So that is by far the most profitable part of Amazon. And again, Jeff Bezos has promoted the chief of the AWS division to be his replacement as the CEO, while Jeff Bezos runs off to become executive chairman and do whatever he does in his free time. I don't know. And of course, Apple had got really good numbers last week, but as well as Facebook actually. But Apple as well as Facebook, their good news was kind of clouded by the insufficient specifics about their financial outlook given the COVID-19 pandemic, because as you know, Apple sells a lot of retail products, and of course Facebook is, again, depends a lot on advertising and page views on their website, so on and so forth. So and of course you had the GameStop debacle. So although both Facebook and Apple released really good results last week, the prices actually dropped. All right, so we don't have to talk so much about Apple. Again, Apple is like Facebook. You don't know Apple, you've been living on a rock for a long time, maybe too long. And of course, Walt Disney. Disney has got three specific divisions. You have got the theme parks, right? So you go to the Disney Hong Kong, Paris, Tokyo, or Florida as well. Every kid's dream is to at least go to Disney once, preferably before 10 years old, because once you pass 10, it's kind of lame, I guess. All right, so that's one, the theme parks. Two is, of course, ESPN. ESPN is the sports channel, the premier sports channel in the US. So, Americans are crazy about either A, basketball, B, American soccer, or C, which is, only these two, right?
Baseball.
Well, huh? Baseball, yes, baseball. Yes, the big three. Yeah, for sure, they do not care about football. Right, so but traditionally every Sunday there's always some kind of game going on. Yeah, so the premier channel is of course ESPN. The problem has been happening over the last few years in that people are cutting the cord. So instead of having an ESPN subscription tagged on with their whatever cable and all that, they rather not pay for that anymore. They probably watch it on some free website or something with a 2 minutes delay, right? So that's always been a problem. And of course, the last part of the Walt Disney business is the Marvel superheroes, as well as the what you call the Star Wars, as well as the Indiana Jones franchise. So you got these three parts. Disney has been executing very well for a long time, and I think maybe too well. That's why not much upside catalyst, as in what is next, because it's already great. How can you be better than great? I don't know. All right, and you've got Visa and Mastercard. So as you know, these are basically credit card companies. So as the economy improves as well, and people are consumption increases, people are using credit more often, then of course these companies will make some money. Now, before we go to the specific consensus ratings for these companies, and I'm just checking my time here, let me just kind of make some general observations of the US market. So far in this current earnings season, about 80% of US companies which have reported their results have beat analyst estimates, right? So that means analyst estimates, they estimate that this company will make, I don't know, 15% growth in revenue and earnings, but it's been beaten. All right, quite a lot of the tech companies have beaten their estimates. So Facebook, Apple, Amazon, obviously. So the tech companies generally have done pretty well. Okay, and of course we cannot forget Netflix a couple of weeks ago publicized that they have got 200 million subscribers already, and they have decided not to take any more loans. All right, so the again, just to dive a little bit more, Netflix growth has been powered by billions of dollars of loans, but apparently they have reached kind of steady state. They are not going to take on any more net additions to their loan book. They are whatever they have is already good enough, and they've got enough earnings basically to create new shows without taking on more money. So that's all great for Netflix as well. Now the problem, of course, is that these companies are relatively expensive from a what you call a PE ratio, price to book, whatever. All these are relative valuation measures, simply because of what's happening in the world and COVID-19. All right, so the valuations are rich, as in they're expensive, right? So how far more can they go before sanity returns? Well, that's kind of hard to say. So a lot of it is actually driven by news as well as sentiment. news about obviously COVID-19. So it's kind of like on and off, right? One day we don't have any news about COVID-19. The next day we hear about Britain, having an out of control second wave and all that. Then the third day we've got some good news, and fourth day we've got some bad news. So it's like this is actually quite normal for the stock market. Stock market is generally bipolar, I think, a little bit insane, but I think that's the normal functioning of the market. Now, my method is for trading is to use the FATA. I think we spoke about it a little bit on Monday for our weekly review session. So FA is fundamental analysis, TA is for technical analysis, and of course this is just in time for Chinese New Year because FATA is FATA, so it's very prosperous. Yeah. Now this is just for trading, not investing. Okay. So because we had a question about US market, and really I'm not sure whether it is a good time to invest in the US market given the rich valuations and the cloudy outlook, but generally it's quite a fun time to be trading. All right. And so let me just kind of mention how I do it. And of course, I am not the guru. I'm not a guru because I do not yet own a Bentley. Once you own a Bentley, like Fang Bun will probably do in a couple of years, then he is the Tusan, the guru guy. All right. So what you do is you just, select a company or a sector that you understand. Maybe you like the products, you use the products, but it's a company that you understand, the business drivers, how they make money, what are the risk factors, so on and so forth. So you just think about it, right? Like, how does Apple make money? How does Sheng Siong or NTUC FairPrice, whatever company. So choose something that you understand and you're comfortable with. And what I do is that I generally do not really read the financial statements in depth, right? Because at this point in time, we do not have an MAS license, so we don't actually issue research reports. So, but I want to find out what is the metadata. As in, generally speaking, right? You've got so many analysts covering this particular stock. In general, what do they actually think of this stock? So, I want to look at consensus analyst ratings. So you want to have a company which is covered by as many analysts as possible. So if you only got one analyst covering this stock, that's not very reliable, right? So you want to have as many analysts covering as possible. As you can see, a lot of the US companies later on will have 40, 50 analysts covering. And this, we're talking about 40, 50 from different banks, different brokerages, so on and so forth. They issue this sell-side research reports, right? So you want to have as many analysts covering the stock as possible. And at least 75% have got buy recommendations. At least 75%. All right, because we are trying to go for the gold standard here, yeah. And the upside potential. So upside potential is calculated by looking at the difference between the 12 months target price versus the current price. So I want to look at things with at least 10% upside, because it may or may not hit 10%, but there are some companies out there, if you do a filtering, that you will find that the upside potential is north of 10%. So it can be 15%, 20%, so on and so forth. So I want to have as much buffer as possible. So if I want to, check the specifics of the fundamentals of a particular company, then I may pick up the research report or I may dive into the financials. But generally, this is kind of good enough from a kind of a overall macro metadata view. So I want to kind of filter it that way, all right? So once I filter my companies, then I'll go to the TA part of it, which is basically a short-term execution. So for me, trend line, support, resistance, as well as price channels are very important. Price channels, I kind of like it quite a fair bit because it seems to work, at least for me, at least for the companies I look at. All right. Sometimes I look at chart patterns. Some chart patterns are actually quite obvious. Things like double tops, head and shoulders, inverse head and shoulders, or let's say a ascending triangle. All these are bullish signals. Sometimes you don't find them, but sometimes you do find them, and they could be quite obvious, right? Then of course I'll look at the traditional RSI as well as MACD. So obviously, if the RSI is around 50, there isn't a strong bias anyway. But if let's say the RSI is about 35 or 32, then it's close to being oversold. That means it might be relatively cheap for the next few days. So that's when you want to kind of think about picking up a couple of stocks. If it's close to 70, like 68, 69, then of course, is close to overbought. They may be a bit rich, and then you might expect some profit taking in the next few days. All right, so you don't want to buy things which are too expensive or too cheap, right? So generally speaking, you want to find a good company from a fundamental perspective, and hopefully the company's stock price crashes, So I was actually hoping for the GameStop Reddit army to kind of crash the stock market, but of course they didn't, right? So that was kind of a missed opportunity there. So you gotta kind of wait for the price to kind of drop. And of course, your MACD can also be very useful in indicating whether it's, the price trend is gonna change or not. So hopefully your chart patterns, your RSI and MACD all point in the same direction, as it give you the same signal to buy or sell or to hold. All right. Now, when you actually come to the operation side of things, the trade execution, generally I don't chase the stock. I mean, it requires a lot of discipline, right? When you see Amazon keep going up, like, last night before I slept, Amazon was already made some money. And then after I thought maybe I should pick it up, but never mind lah, because I'm going to sleep, right? And of course, the stock's chung to what, $3,300 per share. So anyway, don't chase the stock. So only pick it up when the price is low, relatively low, because it's oversold, so the RSI is pretty low. Or if you are really, really convinced the price will go up, maybe based on news flow, based on the business model that you understand, or based on whatever policies the new Biden administration will come out. But of course, this is very short term, because it's only trading. So, don't overthink it. Generally, just don't chase the stock, because wherever goes up will come down, wherever goes down will go up, right? So don't worry. After a while, your favorite stock will, there'll be a lot of price sticking, and then the price will come down. So don't chase the stock. Now, the thing about RSI and MACD, so for example, just I mentioned RSI, 30 is oversold, 70 is overbought. Do check, because every stock has got slightly different personalities. So for example, if you check a particular stock, generally it doesn't go down to 30. Maybe at 35, you already change direction. So you need to kind of moderate your thresholds, your benchmarks. All right, 70-30 is rule of thumb, but do check the historical trend of that particular stock. So maybe the stock never goes up past RSI 65. So when you're very close to 65, you might be thinking of taking profit already. Yeah. And of course, when you want to buy the stock, don't buy just one lot. You buy multiples of 2 or 3, simply because, if the price goes up, you bet the correct direction. You can sell the first half, you lock in some profit, you feel better. Then of course it helps to pay for your own commissions, right? And then you feel a bit smarter. And if the price goes up higher, then of course you can sell the other half, and then you feel like the Tusen that Fang Bun is, and then you can go and tell your spouse how smart you are, which is of course absurd, because you're simply lucky. All right. But the whole idea is that you only buy one lot or one share. You can't do that. You can't split it, right? So you want to buy multiples of 2 or 3, because you can sell in halves or you can sell in thirds, right? Now, of course, if you price goes up, you bet in the right direction and you sell the first half and you make some money. But if the price goes down, you can sell the other half basically to break even, or even to still make a little bit more money, but less than you expected to. But overall, you add the returns of the 2 halves, you'll still be up. Okay. Now, this technique is not about finding the next hole in one or the next 10 bagger or something. It's about making a little bit of money every 2 weeks or so on and so forth, right? So personally, I've been kind of like dabbling in Amazon for a couple of months now. And I don't know, I feel very chill about it. So it goes up, goes down. So last night I could have picked up for, made more money, but doesn't matter. I've already made quite a fair bit of money. So it goes up some more. It's kind of bonus. So I don't know. Maybe after this call, I should just exit my position and sleep nicely. Yeah. Now, let's back to the specifics for each of these companies that we mentioned just now. Facebook, the company where you can put your face in a book. There are 50 analysts, or more than 50 actually. So I'm not going to go down to the details, right? So I'm just painting some broad strokes here. The number of company analysts covering this company is more than 50. Percentage of buy recommendations 86%. The 12-month target price is USD $334. The upside potential is 25%. So this kind of fits our filter just now, right? Now, the challenge with Facebook is that the upside potential has been about 20% for actually quite a few weeks. So I think the volatility and all that scrutiny from Congress about social media and all that is kind of weighing the price of Facebook down. But on a fundamental fair value perspective, it's actually got quite a nice upside potential. And again, that was validated by these results last week. Okay, so Facebook, I guess the price is, and also it swings quite a fair bit. So you might have to wait if you want to trade the stock. Google, of course, the numbers came out very well last night. As you can see, the percentage of buy calls excuse me, the percentage of buy calls is a very healthy 91%. More than 40 analysts are covering this. 12 months target price is 2,151. But of course, a lot of it is already priced in. That's why you see the upside potential is only 12%. All right. So there's some meat on this bone here, but maybe we can find something else. You know, it'd be nice is if it's similar to Facebook, like 25%. But anyway, Google is a good company. And the one that I'm kind of like playing around with right now is Amazon. Again, more than 50 analysts are covering this. Ooh, a 98%, almost a home run here. All have got buy calls, and the target price is some ridiculous $3,941 per share. Of course, not as ridiculous as Berkshire Hathaway, but the thing is, the upside potential is kind of a nice 17%. Apple, for all you fruit juice lovers out there, more than 40 analysts are covering this. 71% are buy calls, target price 148, upside potential 10%. Not great, but again, it's also because a lot of the good news has already been priced in. Traditionally, people do like Apple, and of course, it is a big company on all the major stock indices. That's why the fund managers are all forced to buy it. So, the price is already kind of all baked in. So upside potential 10% is nice, but, could be nicer. All right. And we talked about Disney. This was formerly one of my favorite companies. And I say formerly simply because really it is a very well-run company. It's great. I love the products. I love the movies, right? It's very wholesome. It's one of those things where they will never have an R-rated movie. So it's always good for family, right? Imagine if you go and watch the movie, they only sell one ticket. You bring the whole family there, they sell 4 tickets, right? So it's very, very good, right? The whole problem is, of course, is there isn't much of a catalyst. So they need to kind of figure out. So once Iron Man has died, and of course, Spider-Man needs to grow up, and of course, Captain America does not have Iron Man to quarrel with, so his movie is also dying out. So what is next for the Marvel superhero universe there? And obviously they have got Apple TV, not is it Apple TV? Disney Plus, right? So Disney Plus, they're gonna have their own Marvel shows on that. So we're gonna see how that works out as well. But it's actually a great idea because Disney has got a very long, very large portfolio, like Cinderella animation. They've got lots of shows, so it's kind of good that they are trying to test out their own this online distribution platform rather than to rely on Netflix. Okay, and you got Visa and Mastercard later on. So more than 40 analysts are covering this. 85% are buy calls. What is really interesting is that the upside potential is 18%. I didn't know that, so I learned a bit of that here. So I might take a look at Visa because I've always had a good impression of Visa, right? They tend to be a company that tries to do the right thing. All right. And of course, you got Mastercard, which is kind of similar, but if you can see the buy recommendations, 85% for Visa, 86% for Mastercard are kind of the same. But the upside potential is for Mastercard is a bit less than Visa. I think maybe because Mastercard has been doing well, in recent times compared to Visa, that's why its upside potential is less because the price has been, kind of going up as well compared to Visa. So maybe Visa is kind of the laggard, and that's why it's got more meat on this bone here to go up. Okay, so that's kind of what I have. Just a quick run through. I've already spent about 44 minutes, and I did promise Fang Boon that he will get 15 minutes to cover his bit because there was a question from a previous participant. So I'm gonna defer to Fang Boon for the next bit of the presentation.
Yep, thanks, Ben. So can you see my slides?
Yeah, looks good.
Yeah. Okay, sure. So we have this question, less sexy question as compared to those questions that Ben has addressed. So I think the question is, what is kegel, compound annual growth rate? For those of you who are not unfamiliar with this, and how should you use this matrix, or just should you interpret this matrix? Let me just run through briefly with you. So let us go into the formula of it. So it is really just taking the ending value over the beginning value, and you do it annualize. You do to get the annualized per annum figure. So the ending value and beginning value, it tends to be more than a year. in order for you to have this kegel function, or to apply this kegel formula. So it could be over a span of 10 years, over a span of 3 years. You can just simply use both the ending value as well as the beginning value, and you can get an annualized output as to how much can you expect, how much has the investment grew from a year-to-year basis using this kegel formula. So it does take into account compounding and reinvestment. So it is really like how much have the investment grow on a per annum basis, assuming that you have not cashed out anything of the matter. So it's really what you have, what you are holding, and how much return that you have gained from just holding the stock. So this figure can be applied in many ways. So I think the revenue growth, and to some extent, it is a matrix that is commonly used for computing returns. So we use S&P 500 index. So this is the price index for S&P 500 since February 2001. So you can see that the beginning figure is 1306, and at the end of December last year, it is 3745. So applying that formula, plugging the figures into the formula over a 20-year period, you get 5.4%. So what that implies is that assuming that you have invested one index, one unit of that S&P 500 index, assuming you can do it, you bought it in at $1,306. You have your S&P 500 index, or the investment has grew 5.4% per annum, and by the end of last year, you should have accumulated a figure of 3,745. So this figure, this kegel figure is a smooth out growth. So I mean, this is the same illustration of S&P 500 index. So the red line demarcates the kegel, whereas the blue line shows the year-to-year growth. So for example, you see the Great Financial Crisis, it took a hit on between 07 to 08, but show a sharp increase. So assuming that you have 5.4% figure, it really sort of ignores what is actually the actual growth is. So you get a 5.4 figure very neatly, but it does not really tell you what has happened, or does not really show you the complete picture in between the beginning and the ending value. So that is something for you to take note. So it is a very good tool to compare returns. So I think based on this graph, you would assume that actually Google and Netflix demarcated by Netflix in orange and Google in blue. It does seem like, oh, actually they are, I mean, the graph does show that, I mean, it appears that both stocks are doing about right, about similar. But I mean, if you take a closer look and you compare the kegel, it does reveal that Netflix over the same period has generated a larger growth, has achieved a stronger growth as compared to Google. So that is one. It does provide somehow a good benchmark for you to really compare two stocks or two investments. Okay, so like I said, this is kegel is primarily used by companies as well as research firms to illustrate growth over time. So they typically use it to show that, okay, how much have maybe Apple grew in revenue over the last 5 years, how much returns, or rather for fund managers, they like to use the kegel, how much return have they generated, their funds generated over the last 3 years, 5 years, or even 10 years. I think it is. We would like to throw some the caution to the bring some your attention to some of the details. I think most investors do use this matrix, but I think you need to pay closer attention to the 3 pointers that we have raised. So the time period, the black box effect, as well as the base effect. So I will touch on it next. So what you need to take note of is the time period. So this is the revenue for Apple. So from the period of 2005 to 2020. So you can see that I have more or less boxed them up in the respective 5 years. So it does show a very different picture. So especially if you see analyst report using 15 years, what do you think that the analysts would use for their analyst report? Would it be a 5-year kegel 3.3%, or would it be a more sexy 15 years kegel of 22%? So this is something that as users you need to be aware of, which is sometimes these numbers may not exactly paint the right picture. So I think as a caution, it is always good to refer to the different kegel over different periods. So maybe you can, I mean, these figures you can plug and play yourself. So you can do a 3-year kegel, 5-year kegel, 7-year kegel to have a sense of how much return or how much revenue has the company actually generated. To give a sense of, I mean, we don't take the analyst, or we take the analyst recommendation with a pinch of salt and do our own due diligence. That would be a more prudent way than just relying on figures on the figures provided by analysts themselves. So also be aware of what you don't see. So although it has no, like I said, it only takes into account the beginning and the ending value for kegel computation. But what you don't see are actually the monthly fluctuations. So I mean, these are typically ignored when you're doing the kegel computation. But I think as investors, it's always good to monitor your investments. No doubt you intend to hold them over a long time. Sometimes these dips may be impalatable for your risk tolerance. So it is always good to also dissect. I mean, not just using the annual figures, not just using the kegel formula, but also look into the quarterly figures to see how the numbers have changed over time, just in case you've missed out something that is rather material or has a bearing on future growth and earnings. And I think it is important to read beyond the growth figures. So you can see that the 3 years kegel, the 5-year kegel for the last 5 years as compared to the first 5 years is dramatically different. So you can see that the 5-year kegel was 36.2%, whereas for the last 5 years is 3.3%. So it has a small, the low base effect kicks in. So I think a dollar is 1% to $100 firm, whereas $10 is 1% to a $1,000 firm. So the point that I want to bring about to you is that sometimes kegel can be skewed by low base. So it is easier, or should I say, it is easier for companies to grow at the early stages than a company that has matured, that has already grown quite a fair bit to grow, to expect it to grow at the same kegel. I mean, mathematically, it is something that is rather difficult lah. So that is something for you to consider. And you also need to look at the delta. So although it is reflecting a higher kegel, the delta in which the 5-year is about $51 or 51 billion, whereas this delta is 41 billion, which I think is rather impressive. So I think it is important for you to take note of anomalies as well. So this is the year that has skewed this kegel to be lower than expected, given that this is the year that we see new MacBook, we see new Apple Watches. So if you were to normalize it, perhaps you can see a better kegel number as a result. So back to the earlier point, it's always good to dissect them in maybe 3 years, 5 years, and 7 years to have a more holistic view of how the company has grown in terms of revenue. So last but not least, I mean, I think the point is that it is just really a matrix after all. So you can see that research reports, they like to use kegel. So so a kegel of 22.6%, a kegel of 25.60%. These indeed, they look sexy. But if you were to refer back to the previous point of low base effect, I mean, you could question as to how is it really starting from a high base or low base? So I mean, this is something that as users, I mean, these are good figures, but we need to our advice is to do additional due diligence on the figures wherever we have access to them. Yeah. So this will be end of my part.
Well, thank you for that, Fang Woon. I guess the main takeaway is that the kegel is an average. You just think of it as an average, right? So as with averages, whether it's a stock price or a price of a bar of soap or whatever, there's always going to be deviation. All right, so the average is the average price, but you go to different vendors, the price might be higher, might be lower, and of course the prices can change over time as well. All right, so kegel in a nutshell is basically just an average, right? The average changes over time, and I was pretty, I like that chart that you have with the Apple revenue, because it kind of validates the idea as to why Apple needs to have the Apple TV subscription and all that, because as you can see, hardware is kind of plateauing, so you'll still take a few years for their new M1 CPU chip, which they designed themselves to make it into all their hardware to propel the hardware business to the next level. So they need subscription model, and that moves, or that will take us into our question. We've got two questions. So if you look at this Apple TV or Netflix or even your Microsoft Office, this is a subscription model, right? So if you have your Microsoft Office and you didn't buy it, it's Microsoft Office 365, right? So you just pay an annual fee for it. This is what you call software as a service. All right. So this is actually quite common with enterprise software. So if you're working in a big company, Microsoft Office, 365 is you pay on a monthly basis. If you have things like I don't know, like econometric software or statistics software, same as software as a service, you just pay for a subscription. The whole point is that they want to lock you in, because once you start using their software and you're happy with it and you're comfortable with it, you're unlikely to turn it off. Just like yours truly and Netflix. I've had it for a long time, and um, I am unlikely to turn it off. So every month they take $15 from me or something, and zap, it goes out of my credit card. I don't even see it, right? Like $15. What is $15? $15 is 2 McDonald's Happy Meals. I don't even know what that is. And of course, I'm gonna be like locked in for the foreseeable future, next 30 years or so. So the question was, all these software as a service stocks, should we invest in them? I think it depends on the specific company you're talking about, but the business model as a whole is actually quite attractive. Because once you lock people in, it's kind of a captive audience, a captive market. And the thing is that it is actually more profitable in the long run compared to just selling the software one time. So for example, you buy Microsoft Office 2020 version, you're probably not going to upgrade until the year is 2025, right? So because you want to kind of stretch it out. So, but obviously, if you have to pay on a annual basis, you'll be paying subscription for the next 5 years. And the attraction is that you don't pay the lump sum, so it's a smaller absolute value, absolute dollar amount, so it's kind of cheaper in a way. That's how our minds work. And the second thing is that they will tell us it's more attractive simply because whenever you subscribe to software, you get the latest features. If you just buy it, no change in the features for the next 5 years until you buy the next version, right? But if you subscribe, you always get the latest versions. So I think the business model on its own, without talking about specific stocks, I think the business model is actually very attractive, right? It's just like yesterday I was taking a Grab car. Because I hate to drive in the evenings, because anyway the place I was going to really got no parking lot so I don't drive, so I was taking a Grab car, and this guy, I was talking to the driver, right? He had this very nice Renault MPV with a sunroof. Like, you don't see that, this is like a sunroof. So I was chatting up with him, and so he was saying he's actually driving full time, and he drives 12 to 14 hours a day. That's like crazy, right? And the reason is because he leases the car. So he leased the car, he's a Grab driver, so he makes the difference, right? Well, that's quite an attractive model, because you don't have to own the car. If you have an MPV, it's going to set you back, what, $120,000, $150,000? that's not that's a lump sum, like you need to have the asset first. But the thing is, now you're just making a spread. You lease the asset and you make a revenue, you make a spread. And of course, the spread is kind of estimatable because it depends on the number of hours you drive. All right. So this is also an idea. You don't own the asset, you lease the asset. It's just like the software as a service, right? You don't own the software, you lease it, you basically rent it. It is quite attractive because you don't have to come out with the full dollar value. You don't have to buy the asset because it's a huge lump sum. Right. So I think the business model is attractive. I think it's here to stay. You have the next question, and this one is a little bit more specific. I have shares held for 18 years, and these companies keep recapitalizing it. So I think these companies keep asking for, keep doing rights issues, so on and so forth. So these investors' holdings are generally diluted over time. And the commission is higher than the actual value of his portfolio. So it's basically negative equity for this investor. So the question is, what will happen when he passes on? So does his beneficiary have to take over? Not really, because the beneficiary, unless the share value goes to absolutely zero, which is unlikely because the company is still around. When your beneficiary takes over your holdings, right? It will be negative equity. Beneficiary didn't pay for the shares to begin with. It's basically free shares. Unless the free share is worth zero, it's actually worth something to your beneficiary. All right. So apart from that, I think you should talk to a tax expert, because I'm not sure whether there are taxes involved in that, or what have you. But just from a principal perspective, you are handing over something which has got value, and therefore your beneficiary will benefit. The whole point is that is less value for you simply because of all the share dilution, so on and so forth. But you have taken a hit, right? When you pass it over, the shares are still worthwhile. All right. So at least there's still something left. All right. I guess the other point, ancillary point, is that yeah, it's very annoying for a lot of these companies to keep recapitalizing and having rights issue. I guess the trick here is to okay, I was gonna say select the right company, but you wouldn't know beforehand. I mean, nobody knows, right?
It's 18 years
But
that
you see,
the person hold the stock.
sorry,
It's 18 years that the person held the stock. So, I mean, it is really a long
multiple
time.
rounds of
Yeah.
multiple rounds of share dilution. So that's no good lah. But I guess I'm gonna say something else. Okay, let me just rephrase my answer here. I think if you look carefully, right, the Singapore stock market is different from the Hong Kong stock market, different from the mainland China stock market, different from the UK market, and different from the US market. If you think about it, yeah, Singapore stock market, we tend to have a lot of rights issue, but there are other stock markets out there which generally do not do rights issue. Yeah. So the thing is, apart from choosing the right company, well, you also can choose the right stock market. Yeah. So of course, other stock markets also have got their drawbacks, maybe in terms of taxes, and of course, it's overseas market, so you're not gonna go to the AGM and say anything, right? So basically, your voting rights are kind of useless, right? And of course, the hassle of having dividends paid to you, so on and so forth. So there are problems with overseas market, but then there are markets out there where rights issue are basically non-existent, because that's not the way they want to fund things. They don't raise funds through rights issue, right? They do other things, right? So the one challenge is that if you look at the Singapore debt market, Singapore bonds, right, it's not very liquid. Why? Because companies in Singapore don't want to borrow money through bonds. They want to do rights issues, or they want to borrow money from the bank. But US companies, bonds are good. Bonds are actually cheaper than cash because there's a tax benefit to borrowing money. They get a tax rebate. That's why US companies are incentivized to borrow money, because it's actually cheaper than cash. It's cheaper than equity, actually, right? So as you can see, US companies don't do rights issues. They just basically go and issue a bond, and that doesn't impact investors directly. Sorry, it doesn't impact stock investors directly. But obviously, if the company keeps issuing bonds, then the company balance sheet will be under duress, and then the credit rating will drop. But that's a a problem only when they raise a lot of bonds, right? So yeah, this is annoying, but then we are in Singapore. Our broker platform allows us to trade in a lot of developed markets. You don't have to limit yourself to Singapore markets, right? Okay, I don't think we have any more questions. I think we're already 5 minutes past 8 o'clock. Maybe we can give it a minute or two for any additional questions. But in case nobody else has got any questions, then Fang Bu and I will head down to the local Hai Di Lao and have dinner.
We need to wish the audience a happy Chinese New Year in advance, I guess.
Oh yes, next week we don't have this SIAS. Right. Yes, happy Chinese New Year. If you got extra cash, you can pay us.
Yeah.
We accept ang paos, although both of us are
yang
pao. Yeah, although we're married, but you are shameless, all right? Fang Bun, yeah. Fang Bun and I are shameless. Of course, a bit more lah, because we also need to give some to our events team, which are doing the back end and the operations. Yeah, so.
Yeah, we do have quite a fair bit of the events team with us today. So
make it a big fat ang pao. Is that what you're saying?
not really. Just saying.
Okay. Okay, so yes, we are just joking around. So it doesn't look like as though there are any more questions. So again, from us at the SIAS Studios, have a good evening, and have a good Chinese New Year, and stay healthy. All right. So thank you very much for joining us this evening.